So this is, we went through this at first few slides. I don't even need to go through. We went through this when we did Pro Invest, right? Okay. So what is the situation with Wildcat? What time period is this? This is September 2009. And James Tripp and Catherine O'Brien, Catherine O'Brien, who saved whose life? James Tripp, Catherine O'Brien saved James Tripp's life, or the other way around?
The other way.
Yeah, the other way around.
Very precise, huh, Brenda? You remember? It's like a novel. So anyway, Catherine O'Brien, James Tripp saved Catherine O'Brien's life, right? Anyway, so the building is a 90,000 square foot building. It's called Financial Commons. And the guys who are thinking of investing in this are Wildcat Capital investors. And their profile is as follows. They were founded in 2005. They raised money from wealthy individuals. And they invest in traditional equity and also throughout the capital structure. The case says that their expertise is in mezzanine debt, but they exited out of the mezzanine deals at a profit in 2009, which kind of, sounds crazy to me. And, a little bit of the story is made up. Ample financial resources to pursue new acquisitions. The property itself was built in 1981, 3-story Class B plus office building, situated on a 6.5 acres parcel of land. And this property had major renovations in 2007, just a couple of years ago. The location is Skokie. Anybody familiar with Skokie? Kevin, you are? How come?
I used to live in Evanston, which is the town right over.
Sure. Gross square footage, 90,000 square feet. Rentable area, 85,812, with a large parking lot. Occupancy is 90.5% of the total rentable area. And there's 3 small equal size vacancies totaling about 8,000 square feet. The case tells you something about the Skokie market. It's a part of the near north sub-market of Chicago. Market size is 14 million square feet of corporate office space. Tenants include strong companies, including some national businesses like Peapod and Illinois Tool Works. While Chicago had slight population decline over the previous decades, Skokie and immediate surroundings have experienced slow but steady population growth. The submarket is one of the best performing regions outside downtown in terms of vacancy rates and high quoted rents. And the market around Financial Commons is like Financial Commons is a part of an established business park. And the business park is home to dozens of employers, primarily service and professional firms. Trade area encompass some of Chicago's most affluent zip codes and one of the region's strongest residential markets. Financial Commons is less than half a mile from a 2.7 million square feet super regional mall, Westfield's Old Orchard. This time period is around immediately around the aftermath of the credit crisis. Bank loans, especially commercial mortgage, is difficult to obtain. National and regional banks have been burned by real estate and construction lending as defaults have climbed. Loan originations are at an all-time low, and if you consider credit to be oxygen, asset markets have been deprived of oxygen and have collapsed. And it's difficult to obtain valuation benchmarks. The case tells you that they were able to obtain some loan terms, the loan is 65% LTV, 6.75% annual interest rate, maturity 5 years, amortization term 25 years, monthly payments, prepayment during term to maturity of 3 years, maturity 5 years. and prepayment penalty 3% of all balances prepaid. Right? How does prepayment work? What are the different ways prepayment works? Yes, Alex?
You pay off your loan before the end of your 5-year term, you have to pay 3% of the outstanding balance. And technically, it's not supposed to be called a penalty because penalties are illegal.
Well, yeah,
I know.
but the legal lawyers will find a term, right?
Yeah.
It's a breakup fee or something. Yeah.
So there's defeasance and yield maintenance and a lot of CMBS debt.
Yes, yes. And how is that different? I mean, what does defeasance and yield maintenance imply?
I always mix the two up, but I believe yield maintenance is taking the treasuries and swapping it for the actual yield that a lender would receive from your loan. So depending upon where the tenure is, it could be very expensive to prepay a loan.
Sure. Anyone else? How does prepayment work? I mean, this is a very simple case, 3% of the outstanding loan balance any time before term of maturity. Now, the yield maintenance concept is essentially what a bank really aspires to get compensated. The idea of yield maintenance is when the bank lends you, they have a certain yield in target in mind, based on the life of the loan. And to the extent you prepay, the bank wants to be compensated to get them to their total expected yield at the time of the origination of the loan. That's what yield maintenance means. Defeasance is a concept that allows them, sorry, what is defeasance though? Yes?
I think defeasance is what you described.
You may be right, I always mix it up.
Defeasance is when you set aside some treasury securities.
Yeah.
That goes on to pay, at least the base rate to the bank, right? The bank gets paid at least the yield on the treasury. So the equity terms are, LPs will give 95% contribution. Their capital is 95%, Wildcat is 5%. Any shortfalls will be funded 95% by LPs, 5% by Wildcat. LPs get 8% preferred return. Did we discuss what preferred means when we discussed Pro-Invest? What is preferred? Yes?
They get it first
Yeah, but why would somebody get preferred?
because they're contributing 95% of the capital.
Yes, and so generally what is preferred smell like, taste like, feel like? It's like debt interest. It is to compensate you or give you protection, at least to treat your first 95% of the total equity raise, which is large sum of your money, give you the comfort of a debt investment. And that is the compensation for it, and you also get upside up to a certain max. Right? Is there a preferred for GP in this case, for Wildcat? There is no preferred for Wildcat, it's only preferred for LP. Wildcat is putting 5% of the money, right? Why should Wildcat not get any preferred?
Should.
They should?
Yeah.
No, they get the promote, right?
They get the promote, right? Right. Thank you. So leave the promote aside for a minute. Should they not get, they're also putting money, right? Why should they not get any preferred? And if so, how do they get preferred? Or there are ways to circumvent preferred? We'll deal with all this, yeah, Alex.
Well, I was just gonna say, they get a clawback, they get a catch-up, so it's not a preferred, but at
Who
least,
gets a catch-up?
Wildcat.
In the case?
Yeah, I think they do, don't they?
I doubt it.
No, they do in like the last
That's just.
scenario.
Oh, it's in one of the, yeah.
Scenario.
One extra scenario which deals with a little bit of catch-up. Anyway, we'll come to that. So most likely, if you remember the conversation, you know, when Wildcat puts in 5%, if they want preferred, then they should bring their money also as like a GP. As a LP, I mean, sorry, like an LP. You remember the diagram we did in ProInvest? They can bring their capital as LP. So we treated like, the capital gets treated like LP. And the GP entity has no asset, nothing in it, it just collects the promote. So that's the way, you know, a good lawyer will advise you how to do it. And then unpaid preferred accumulates forward until the property is sold. If there is a shortfall of preferred, then it gets accumulated. And we got to figure out what that means and what it means to get accumulated and what are the financial implications of that. Until the property is sold. And then there is, you know, first of all, there is promote, which is any cash flow above the 8% split is split 30% to Wildcat, 70% to LP. Right? That's what you were saying, Brenda. That is the promote. Who gets promoted? Wildcat.
LPs, I mean, well, the GP is getting a promote, but the LPs are being promoted.
Yes.
Yeah.
The LP is being promoted. The idea is as follows. Because the LP is getting a preferred, they are being promoted. And they're specifically being promoted because the GP is not getting a preferred and the GP is getting the back end, the promote. They're receiving the carried interest, what it's called. And as a result of that, it's actually the LP that is getting promoted. LP is becoming senior. That is the idea behind promote. And upon sale, the proceeds to first go to pay down the outstanding debt, then return the investment capital to LPs and Wildcat, and then the remaining is split 30% to Wildcat and 70% to the LPs. And there is a management fee that 1.5% of LP's initial equity investment paid annually from operating cash flow of the property. Right? Who receives this 1.5%? Wildcat. What is if you were to put a number on this, 1.5% of what?
The equity.
Of the total equity?
Yeah.
Open it up.
The LPs.
LPs.
Of the LP's equity, yes. Although if the LP is not astute, then these guys can try to get paid on their own money also. Because if you make an argument, I'm bringing my money as an LP, I should get one paid on, you know, management fee on that. But the astute LP, the rest of the 95% providers of capital, they will object to it, strongly object to it. Okay, and the underwriting is as follows. The holding period is 3 to 5 years, depending on the different scenarios. The exit is based on 8.4% cap rate applied to next year's NOI and implies a sale at $150 per square feet after 3 years. And the leases are January 1 to December 31st. This is just a simplifying assumption. And they're either triple net or a few of them are modified gross leases. There is annual rent increase of 2%, renewals at 2% of a previous year's base rent with same level of expense reimbursement. Okay. Average rental rate in the area is $21.18. Reasonable rent assumption is $21. Leasing broker commissions, 2% of the first year's gross rent. Credit loss assumptions, 3.5% of realized income, gross income less vacancy. Operating expenses are given flat at approximately 61% of the realized rental revenue, and it increases at 2.5% per year. And this is the rent roll. So 5 leases are triple net, 4 are modified gross, and this actually is going to help us put together the revenues, right? Put the pro forma together. And this is office sales comparables in the neighborhood. So they had how much? safe, right, 140 per square feet after 3 years. Okay. So what does the deal look like in terms of Catherine O'Brien's contribution and seller situation, the price and valuation? The case tells you it's an off-market deal. Selling price is 10.4 million. And this selling price is a 20% discount from the present owner's purchase price. 13% below the currently outstanding debt. It's a reasonably attractive investment, right? So the question number 1 that was asked of you was, complete the waterfall shown in Exhibit 10 of your case using the benchmark assumptions outlined. Under these assumptions, calculate the expected return to Wildcat and its limited partners and compare those returns to the property level return on financial commons if it were sold after 3 years. And returns to Wildcat should be calculated without including its management fee. Okay. For each of the following scenarios, recalculate spreadsheets for Exhibit 9 and 10. With the exception of the changes noted below, keep the benchmark assumptions constant. Each scenario is to be recalculated independently, that is, each scenario is to be treated as a distinct variation from the benchmark. That's why you had so many different sheets of covering each scenario that I had provided. Okay. Now, assume that the outside investors will become partners with Wildcat only if they believe they will receive an IRR of at least 20%. And Wildcat will only close on the property if it believes it can earn a 50% IRR. Discuss whether or not the deal will proceed. Okay? So, this is your base case scenario, where the holding period is 3 years. You know, potential gross income, this is your occupied space. No. This is your total space, rentable space. And these are calculated based on the rent roll. Okay? And the vacancy, it tells you, is 8,127 square feet. If you lease it up, you lease at $21 a square feet, and 1/3 of the space is being let every year. So by the 3rd year, there will be no vacancy. And then credit loss assumption is 3.5% of what? Credit loss is calculated as 3.5% of
Realized.
effective rents, which is rents minus the vacancy, right? And why is that?
Because it's based on actual, on the rent roll, essentially, 3.5% of your tenants will not pay the assumptions.
But why is that?
What? Why isn't that what?
Why do you have to base it on effective rents?
Because an empty room won't
Otherwise-
fail.
Yeah.
Is what?
An empty room won't have a credit failure.
That's exactly right, yeah, very good. So then you get effective gross income, which is this, right? You get this. Expense reimbursement is given from the rental. All we did was we added the expense reimbursements to get to this. And then we had total operating revenue. And then operating expenses are 61% of the operating revenue, and they grow. So the first years is 61% of this. And then this is 2.5% growth from year to year, and so on and so forth. Okay? And then you get the NOI. Tells you that it could be some capital expenditure, there is leasing commissions, because this space is going to be leased in 3 phases, there is a 2% leasing commissions in the 3 years that you have to pay for. And you have management fee. Management fee is 1.5% of the amount of equity, 95% of the amount of equity. Yes, Taylor?
Sorry, I missed your comment on leasing commissions.
Yeah.
2% of,
The amount of rent you will receive in that year from leasing that space.
okay.
That's the assumption. It could vary, right? Different leasing commission structures are out there. So, but
So
this, sorry?
That was hard coded for us then, right, in the model?
No, in the model, everything is linked.
Okay.
Yeah, if this would be 2% off, you will have to link it up here. No, not the vacancy, but how much space you, 1/3 of this times 21, times 2%. Okay. Now, why is management fee here? How could management fee work? How does management fee work? So this is your investment, property. This is your GP, LP, and this is your GP's asset management business. And in ProInvest we saw this is the business that creates value for you. This is the entity that just collects your carry or your promote. Right? So GP provides 5% of the equity, and these guys provide 95%. And the management fee is only on this amount of equity. But here, they have this management fee as part of the operating pro forma of this investment. You know, when one way for this to work is, these guys make a commitment of your equity, right? And the management fee can be directly drawn from that commitment. Now, why is it drawn here? Is there a difference between this and this? Here you have some committed amount, a part of which is put in a escrow and to be drawn upon, or the management fee can be assigned in an escrow account to be drawn. And that would allow the GP to draw directly the management fee from their account. But the LP is saying, no, that's not the way we want to do it. You know, you brought this property to us. You have to show us the money. If the property generates the money, then you get the management fee. Now, this can be a very complex conversation with the provider of capital. Because your view should be, we are managing your money, and how the investment does, if we are asked to draw our fee from this, that means if there is, for whatever reason, there is no cash here, or things change, then we will not get any management fee. Right? So there is a fundamental difference between the two. Here there is more guarantee of you receiving a management fee of 1.5%. Here not so, there is more uncertainty. This is predicated on the success of the investment and the property generating cash flow. So that's number one to take care of. But here, that's the way it is set up, the conversation you can imagine between the two. Yes, Carter?
So you're saying the difference between the chart that you drew is money going into an escrow account versus the income statement that we're looking at, is the money's coming straight from the revenues of the property?
Yes, it's different, right? What has happened is here the LP has committed 95% of the equity. And so the way they will set aside 1.5% of that on an annual basis for this, right? You can draw on this directly, or issue a direct capital call to get paid on your fee. Now, there you have a direct access to their account, or access to, form of a capital call, but here it is saying a different thing. Here it is saying, if there is cash here, only then you get paid. It's a different dynamic. For the GP, this is a lot more risky. Right? What would your argument be as a GP? You say, how will you counter that argument if the LP is pushing you to get your fee here rather than there? Large investors, pension funds would want you to take it like this, but may ultimately agree to giving you that way. Yes, Carter?
My argument would be, well, I want to make sure that I'm doing what's right for the property investment that I'm doing, and now.
Yeah, but so my counter argument would be, yes, that's fine, but you brought this property, you're showing all this is going to generate this amount of cash. So show me the money, like Cuba Gooding Jr., right? Generate the money and show me the money and you get paid. Why do you want direct access to, right? Means why should you get paid unless you show me the performance? Yes, Alex?
Because there are a lot of businesses in which asset managers and money managers get paid, no matter how the performance is. I'm working either way.
Who's working at the way?
Say, if you're the asset manager through the GP.
Yeah.
You're working on this one way or another, so the asset management fee is simply you're getting paid for
No,
the
but
time.
if for some reason you don't have, let's say if this is zero,
Yeah, I understand.
what happens to this? You don't get paid.
Right,
But you still working.
but you're still working.
And I wanna have the flexibility to be able to maybe change the use of the property if that's gonna be the most advantageous.
Fine, that is, it's discretionary capital. And if you have the right promote structure, then you have more flexibility. But what does this mean? What do you mean by working?
Isn't that the fee that you get paid for managing and, right?
Managing the capital, right? But conceptually, that is what the fee is for. But how it is paid? There, it is paid just for managing the capital. There is a recognition, you get paid irrespective of what you do with the property. Here you are saying you get paid only if the property performs, although you will get paid 1.5% of that amount that you work. So that, is it?
Yeah.
Yeah. Brenda, is that difference okay? So what will be your counter argument? Your counter argument is going to, we have to run this business. You don't want us to fail, you want us to succeed with this investment, right? The GP is making this argument to the LP. And we have some operating budget, we want to meet that operating budget. If we don't meet our operating budget, we are likely to fail. And if for whatever reason something happens here, this goes to zero, we don't get paid, you're setting us up for failure. And you don't want to set us for failure, that will be your counter argument. We will try to do our best, we've been transparent with you, we have shown you everything with respect to this asset. If something changes in an unforeseen way, then at least we should be able to run our operations, right? So that will be the argument, and there will be some balance that will be struck here. One of the ways could be, okay, you get paid here, if there is a shortfall, we'll deal with it right here. Okay. Then, reversion sale price is 8.5% cap rate, and we forecast the NOI to the fourth year, applied 8.5% to this, we got 12.4 billion. And we calculate before tax cash flow from operations, and property before tax cash flow, and property level IRR is 14.22%. And as I have always argued to you, the first thing that you should do is always calculate your property level IRR. If the business makes sense in a property unlevered IRR basis, unlevered means what? No debt, as if it is all funded with equity. That's what it means, right? So if it makes sense this way, and then there is this benefit of a difference between your returns on an unlevered basis and your cost of debt, you will accrue the benefit of leverage. Otherwise, leverage will, otherwise what will happen is, the GP is going to come to you trying to put in as much leverage on it to squeeze out a few returns. What does that do? Well, perhaps convinces you from a model perspective, you're meeting your target, but there is so much additional risk built into it because of leverage. Okay? So property level IRR is 14.32%. And then the next step is to determine what your equity level IRR is. In order to do that, you have to figure out, what's the impact of leverage between the unlevered, the leverage, and the equity level IRR. Can you see, Nate, from here?
Yeah.
Okay, so we had a purchase price, LTV of 65%, interest rate of 6.75%, amortization period 25 years, monthly payment, so 25 times 12 is 300. term to maturity 5, prepayment penalty of 3%. Is this the only way that the bank decides to lend you 65% LTV? How does the bank decide to lend you how much money they're going to give? Are you familiar with loan sizing?
Debt service coverage ratio.
Sorry?
The loan size with the debt service coverage ratio.
Yes, the 3 tests, right? Debt yield, debt service coverage ratio, and the loan to value. And the bank will lend you the lowest of the 3, right? This is a simplifying assumption, they give you 65% of LTV. So before tax cash flow for the property is basically this, same amount, which is here. And then, obviously, the purchase price is 10.4, of which you're borrowing 65%, which is 6.76. And you can calculate what will be your payment to the lenders. So you have to pay debt interest, and you have to pay principal amortization, total debt service during the holding period. This is your outstanding loan balance, and your penalty is 3%. Because it's only a 3-year, you are selling it 3 years, which is before the 5-year maturity, you have to pay 3% prepayment penalty. Alright? And this is your cash flow to the lenders, therefore, in the event of a 3-year hold period. What would the lender will do with this? They're getting their own IRR on this, right? They're estimating their own return on this. Now, 10 point, this line minus this gives you your cash flow from operations. And then you add back this 5.8. How did we get to 5.8? It effectively means this 12.4 minus this 6.414680, that gives you this. Minus prepayment penalty. So this is your cash flow to equity. Equity is 24.98%, roughly 25%. From 14.3% to 25%, right? This is happening because of the benefit of debt, right? The lower cost of debt. Okay. Now, the next step is to figure out what will be the capital account of each of the parties, because now you have to see from the equity level cash flow that you're receiving, how does that money get distributed, right? That's the next step for a waterfall. So in order to do that, you have to set up the capital account, and the capital account will take into account the terms of the deal, both for the investor and for the GP. So the investor puts in 95% of this equity amount of 3.64, which is 3458. That's the beginning balance at end of year 1, the beginning of year 1, or end of year 0 balance of 3.458 million. So next, this is the beginning balance in year 1. And then there is a question of annual preferred investment. This row is it represents any new money that will be brought into this deal by either of the investors, right? So now, what would be the case in which the new money would be required to be brought in? When there is a shortfall. There is no shortfall here because there is cash being generated, so nobody is to bring any money, new money into it, that's why it's blank. And then preferred return earned. Earned. What is earned? Earned is what is contractually the amount of preferred return that should accrue to you based on the terms of the deal, right? So you have 8% preferred. Everyone okay with this? 8% preferred, that's given. 8% of what? 8% of the equity account balance at the beginning. Remember, this is like, preferred is being treated like debt. It's the interest on the debt that you have to provide. And interest because the interest will be applied to the beginning account balance. That's why 8% of that is 276,640. And same for each of these years because the for whatever reason, this doesn't change, and we'll see why this doesn't change. Now, this is your earned. Then you have to match your earned, compare the earned relative to the cash being generated, operating cash flow. If what is earned is less than what is being generated, then they get paid what they earn. Make sense?
Or what is being done?
This is the money that the property is generating, 276,955 in the first year. This is what they have earned, 8% based on their equity account balance. Now, if what they earn, what needs to be paid to them, if that is less or equal to the amount of money that the property is generating, then they will get paid all of it. Make sense, Harris? Kevin? And here, this number is less than this, so they will be paid everything that they earn. Okay? They will be, in the future scenarios, we'll see if there is a shortfall, what happens. So therefore, as a result of that, the unpaid preferred is nothing. All of what they earned got paid, so there is nothing unpaid. So what will be your ending account balance? Beginning account balance. No new money was brought in, and there was no accrual. So the ending account balance is the same as the beginning account balance. Nothing changes in the account balance. Right? So this becomes the beginning account balance this period. We'll go through the whole process again, and so on and so forth. So at the end, they still have 3.458 million of their own equity tied up. The LP. Does that make sense? Okay. So this gives you a sense of the LP's account balance. This is essential for you to maintain. The LP will maintain. Who maintains it for you in a private equity fund? You have to have somebody on the accounting team for your side to observe all the cash going in and out. Right? The property level cash flow will be maintained by the reporting, the trust companies that provide that service. Probably charge you 70,000 if you're a startup fund. If you are a little bit more mature, they'll charge you a percent of your assets. Varies, somewhere in the range of 100,000 to 200,000, right? But they will have their own system, record the cash flow flowing in and out of the property. But this you have to do on your own, and you have to try to make this transparent. You can set this up on platforms like Intralinks. In fact, some of the trust administrative services providers for the fund will give you the flexibility for you to observe this and give selective access to your LPs who can see what their account balance is, and they can reconcile on their end. Here, we have just taken one blanket LP, right? There could be 100 LPs in this. So each LP will have to have their own account balance. And that has to roll up and consolidate as one. So the problem becomes quite complicated. And this is a situation where we are assuming that all the LPs have the same deal. There could be a situation where their LPs may have slightly different deals. Well, what will be the case when the LPs have a different deal? If you bring in an anchor investor, somebody who commits to you first, they could get a better deal, right? And the subsequent investors may get a deal which is slightly different, or sometimes even meaningfully different than the first investor, right? So the account balance, structure of the account balances changes. Yes, right?
So you need one of these for each different LP.
Yes. And then you roll it up. And this will be effectively your roll up. Okay? It becomes complicated. And the banks also, right? The Citibank, whoever you have your account with, where cash moves in and out, they will also help you with this. Now, the Wildcat Equity Capital Account, what is happening with them? They put in 5% of the total equity, which is 182,000. Then it says annual subordinate investment. So basically what this is saying, any new money brought in. There is no new money brought in. Why is no new money brought in? What is the test?
Shortfall.
There is no shortfall, so no new money is required. And this is the subordinated return earned, basically nothing. They don't have a preferred. So there's nothing paid, and therefore nothing accrued. So their equity account balance stays the same. Is that okay, Cyrus? Mr. Yu? Okay. And then you have your operating cash flow. You can use these equity account balances and the equity, this is all the cash flow that is available to equity investors. This is available from an operations perspective, and this is available upon sale, the 5.8. So purely from an operations perspective, you have to see how much money is actually flowing in to the LP. So here, they put in 3.458 million, which is this. They're receiving what they're getting paid, right? Which is this. But this number is different than this. Why?
Because they get their preferred plus 70% of the remainder.
Yes. Yes. So the difference between this and this, right? This, what they're getting paid is less than how much cash the operation is generated from the operation. So there is some delta between the two, positive delta. Now the terms of the deal say that delta is split 70-30. Who gets 70? The LP gets 70, right? So LP gets, this plus 70% times 276, 955 minus 276, 640. That number is equal to this. Does it make sense? And the other 30% goes directly to here. The 30% of this number, of this, just this part, this minus this, is 94. Okay? And this is just divvying up the operating cash flows. We have ignored what happens upon sale. Now, the case tells you that this is 70%, 30% pari passu. Right? All familiar with what pari passu means? What does it mean? Brenda?
Proportionate to whatever you invested.
Proportionate means prorated. Proportionate means prorated. Pari passu means the level of claim, the level of the claim, seniority of the claim is the same. That's what pari passu means. So every dollar that comes in gets divided 70-30 between the two. Prorated means 70-30. Prorated could be there in place without pari passu, right? If there is no pari passu and it is still prorated, that means who will have the first claim? The LP will typically have the first claim, unless there is a catch-up provision, right? So in which case, the first 70 cents goes to the LP, okay? So it is important. This subtle difference can have a big impact. You may have the right kind of a proportion, but the seniority can really protect you or kill you. Lack of seniority can kill you, right? So, all right. Any questions on this?
So you said the first 70 cents will go to the LP,
Yes.
but there's no difference in seniority.
No. If there is pari passu, if there is they're both at the
Dollar
same
comes
seniority
in.
level, then it is like for every dollar, 70 cents goes to LP, $30, 30 cents goes to LP. Yes. If that was not the case, who will have the claim first? The LP will have a claim first, right? Typically. unless you are so good in your deal making, right?
Sorry, what do you mean when you say the LP would have the claim first?
If you don't have pari passu, if you don't have equal seniority,
Right.
then the claim, the money coming in will be first paid to the LP,
Okay.
right? And then the remaining would be paid to these guys,
Okay.
okay? So, let's say you settle the accounts at the end of the year or on a quarterly basis, also do you do it?
Mm-hmm.
Money doesn't always come at the end of the period, it goes through time, right?
Right.
So, as the money is coming in, right, you have to allocate money between the two. So, the first money that comes in, where there is no pari passu in a situation like that, will first accrue to the LP's account, okay?
Mm-hmm.
All right, any questions on this? All right, so the next is, what do you do with the money that you generate from the sale of the asset? What should you do? You received 5810 from the reversion cash flow, 5.8 million, right? So, at the end of the third year, what is the equity account balance for the LP? 3458. And the GP is 182,000, right? So, upon reversion, the sequence of the distribution of this 5.8 million would again depend on the terms of your deal, right? If it is pari passu, 70-30 as is stated in the case, then dollar for 70 cents, 30 cents will go to pay these two. But if it is not pari passu, the first money goes to pay, return the equity of these guys. Right? Makes sense? What if it's not 5.8 million, it's only 3 million after when you sell the property? Who gets paid first in the absence of pari passu? The LP. If it is only 3.84 million left from the sale of the property, then you will have to be returning the equity invested of the LP, and the GP does not get the recovery of their equity. It's only when pari passu that a dollar is getting split 70-30 between the two parties. So this may sound very straightforward, but it has profound financial implications, especially as the dollar numbers grow and the seniority is affected. Okay? And then this 380,035, this is the investor share of the operating cash flow, which is basically this number, 380, this is what the LP will receive in year 3 from the operating cash flow, 380,000. And which is this? And then it gets into a couple of other things. One of them is additional proceeds needed to guarantee the target IRR. This only applies, the rest of this only applies to these two, the yellow ones, only apply to question 2D. That's scenario 2D. Doesn't apply to 2A, B, and C. Okay? So we leave it open. Now the question is, this we had generated, write it here, 5810226. From this, you paying this first, actually both of them pari passu. So let's say these two you have paid from this. So whatever is left is X. Make sense? After returning the equity, you're left with X. X gets divided 70% and this gets 30%. Those are the numbers. Okay? Now, this allows you to see who is getting how much at the time of reversion or sale of the property in year 3. So this will be the LPs, what the LP will receive. What will they receive? They will receive their equity, return of equity, plus the 159, 1519, 158. That is this number. How much will the GP receive? 182 plus their share of the excess cash flow, which is 30% of this. This plus this is equal to this. So now you can construct the cash flows for both the parties. Investor gets, they put in 3.458 million, and this is what they get in terms of their preferred plus their share of the excess cash flow from operations. And same here, and here they get this 4977,158 plus the 380,035, which is this number. Okay, and for the GP, they put in 182,000, they get 94. Here they get 2205, and they get here, how much do they get? They get 833,068 plus the 44,312. So that combination is 877,380. Right? So now all you have to do is you do an IRR, 21.2% and 71.4%, and so therefore, based on the simplistic assumptions that the case tells you, this deal will work if the LPs get 20% IRR and if the GPs get 50% IRR. So this deal works in the base case scenario in spite of the prepayment penalty, right? Now, there's one more thing I wanted to say. Okay. You will see one more important thing to remember here is this. You remember we had an equity IRR of 24.9%, roughly 25%. This was significantly higher than the unlevered IRR of 14.32%. So we are saying there is a benefit of leverage which is accruing to and resulting in a higher equity level returns because of that benefit. Now, what happens from here? How much of this set of cash flows goes to the LP and GP tells you who the benefit of leverage actually accrues to. Let us see. Here, when you split your equity level IRR between LP and GP, what should happen to the LP's IRR and what should happen to the GP's IRR? The LP's IRR should be lower than the equity level IRR. That is your test that the deal is working and you have not screwed up as a GP. Okay? Because anything you give from the equity level cash flows to the LP is going to reduce your cash flows. So the LP level IRR will be always typically lesser than the equity level IRR. Otherwise, you may have given up too much. And the GP level IRR will be substantively higher than your equity level IRR. So what does this tell you about the benefits of leverage and the deal structure? All it tells you that most of the benefit of leverage only accrues to the GP. LP doesn't benefit from leverage. So if you are an institutional investor, you really want to control leverage. Because you are not benefiting on the upside, your position is being put at risk. All the benefit of that is accruing to the GP. And you remember the principle we discussed in the class the other day? The secret sauce of success in life is protect your downside and upside will take care of itself. This structure is a classic example of that. For the GP, what is the loss? At loss, 182,000. That's their equity they put in. And if you go back, how much fee they have earned? Roughly 158,000. So they put in 182, in the 3 years, they got back 158,000. So their at-risk capital is only 22,000, right? So you have an incentive to squeeze out as more return as possibly can, and you lever it up. You have reduced your downside by drawing on the equity, drawing on the fee, and then set this deal structure in a way that you invested 5% of the equity, and you're receiving 30% of the excess cash flow. So what is the promote amount?
30%.
25%. Of the 30% you are getting, 5% is for your own capital contribution. So the promote is the 25%. So you can say, I put in 5, I got 25, so it's a 5 times. Cannot be a bad deal, right? So your downside is protected and you're getting all the benefit of the upside. It's a classic manifestation of that. And to top with that, your promote or your carried interest is taxed at the capital gains tax rate. All right, no wonder we have a response from the left. Right? So it's a pendulum swinging the other way. Okay. Any questions on this? Yes, Scott.
Why is the management fee not included in returns for the GT? Is it because it just keeps, it's like operational?
Well, the management fee, the way you think about management fee conceptually is, sorry? Yes, who does the management fee accrue to? To this business, right? They are getting the management fee. Typically, what will happen is, the management fee you earn would probably be taking care of the expenses of this business, as what Mr. Shi was trying to say. So there is not going to be too much delta. And if you had gone to raise this money with some private placement agent, think about it, we discussed in Pro Invest. If you get a private placement agent to help you raise the 95% of the capital, which is 3.458 million, they will charge you how much? 3%, right? Where does that money come from? That money has to come from the fee you are getting here. That money you cannot pass along to these guys. Unless there is an exception, unless you are such an established GP that these guys are queuing up to invest with you, then you can make an argument, you deal, it's your private placement agent. The fact that you hired the private placement agent in use will require you to pay the fee, be responsible for the payment of the fee. So, how do you budget this? You budget this by putting your org chart together, preparing a budget, your operating budget, and keeping a cushion on top of it, and then saying, this is what I need in order to run my business. Anything short of this, you can cut down my management fee, but I'm not going to survive, so I'm not going to do this deal. If nothing is going to accrue to me, what am I going to do? Especially keeping in mind that your entire focus is limiting your downside. You don't want to take on this project where you are draining your own cash flows. Okay, you already committed 5% of the capital. All right, any other questions? All right. So that was solution 1. Now, this is property level IRR versus equity level IRR at various loan to value ratios, right? So equity level IRR is increasing. Property level IRR is pretty stable. But property level IRR also has a slope. Why? As you increase the leverage, your property level IRR increases slightly. Kevin?
Because the management fee goes.
Yes,
down.
as you increase leverage, your equity amount goes down, and therefore your management fee goes down, and therefore your returns are slightly boosted, right? Particularly in this structure where the management fee is coming from operations. Okay. If I were to do this deal, I would never agree to this management fee coming from operations. I would say, you making this capital commitment, it's what happens if there is some, whatever shortfall, we don't get paid. So you have to be honest and clear about, okay, it's okay to say no. Only take on things which you can deliver on, otherwise there is no point. You're setting yourself up for failure. Okay? All right. The next question is, one of their tenants, North Shore Bank, is not renewing its lease at the end of year 3, and its space remains vacant in year 4. A new tenant begins leasing the space in years 5 at $18 a square foot, which is less than the 21 that they had. On a triple net basis, lease requiring $5 a square foot of expense reimbursement. The new lease does not contain any rent escalation clause, so the rent is flat. To make the space suitable, capital expenditure of $4 per square foot are required in year 5 for the tenant improvements. A leasing broker charges Wildcat 2% of the first year's rents as a commission. As a result of this turnover, Wildcat holds the property for 5 years. So the scenario has changed a little bit. And let's see how that evolves. Okay. I was planning to teach this case with a joint class session with you guys and MIT, because on the 22nd is your workshop, right? 22nd of November. So they would have come here 21st night, and we would have last, spring semester I did a joint session. But unfortunately can't do it this semester. I'm not here. But that is always a lot of fun. Good thing for you too, because after that class we will go out and have dinner. So, anyway, who said they cannot attend the MIT workshop this year? Kevin, and who else? Everyone else can? We'll just open a spot for somebody else, my friend.
Do we need to sign up for that, or?
No, I'm the sign up, it's in my hand. I'll make sure that your name is there very shortly. I just want to know who cannot attend, because then I can give a couple of slots to those who are in my capstone class. Alex is already here, so it doesn't matter. All right. So in this scenario, the whole period is 5 years. So we had to extend this analysis for another 2 years, and then this is the additional year. Here, the gross revenues are based on the information given here. $18 a square foot on a triple net lease, but only that part which is presently being occupied by North Shore Bank. So we forecast this going forward. Vacancy in year 1, this initially vacant space is being leased 1/3 each year. So here vacancy falls by 1/3, and here it falls to 0. And then all of a sudden, this area, this amount of space, multiplied by North Shore's rent, is the vacancy, 782, 388. If you look at the rent roll, you will be able to calculate this number, okay? But in the next year, the vacancy goes to 0 because a new tenant comes in, okay? And the credit loss, we know how to calculate, 3.5% of the potential gross income minus the vacancy. That is this. Then we have expense reimbursement. The first 3 years is the same, and then here, based on this, expense reimbursement is $5 a square foot, which you have here. Now, why is it low here? Because of the vacancy. There's no expense reimbursement. It all kicks in here in these 2 years. Okay, so we have the total operating revenue now. We have and the operating expenses, 61% of this, growing at 2.5% going forward. Okay. Capital expenditure, 2%. I'm sorry, capital expenditure. It says here, capital expenditure is based on this. $4 per square foot required in year 5 for tenant improvements, which is this. 4 times the new area that will be leased. And then you have leasing commission, you had in the first 3 years for 1/3 that was leased here. And then this is related to this new space that's being leased. And then you have management fee. Management fee is still constant, but it is predicated upon being paid out of your operations, still. And therefore, and the reversion sale price is 8.4% cap rate applied to the net operating income in year 6, which gives you 34 million. And property before tax cash flow from operations is this. And therefore you have property before tax cash flow, you do an IRR. IRR has dropped from 14.38 to 10.07. Now, yes, Taylor.
So in year 4, the investor has to inject for a shortfall.
Let us see.
It was just because it was on the sheet, but for the management fee for committed.
There is no shortfall. If you see, on a pre-tax basis, on a property level, unlevered basis, there is no shortfall. There is still positive cash flow. Here it has dropped to 14,782, right? But it's still positive. At the property level, it's still positive, okay? And so property level IRR has dropped to 10.07. Relative to the base case, what is the difference between the base case and this case? 2 things. One, your holding period is expanded because you have a vacancy. And this scenario is isolating the impact of a large vacancy that may take place around the time that you're about to sell this property, and then you hear, the not sure is leaving, you really don't want to sell because you want to keep some of the value for yourself. So you decide to hold it for another 2 years and find a new tenant, so you can capture the value rather than giving it to the tenant. Now, the next step is again the same, going through the debt process. And here, we have the property cash flow. We go through the debt, and we have the debt interest payment, principal amortization, debt service payment per year. That will not change because the term of the loan was 5 years. Still the same debt service. What kind of mortgage is this called? Sorry?
Constant payment.
Constant payment mortgage. What is the other kind of mortgage? Taylor, you remember? And one more?
Constant amortization.
Constant amortization. What's the difference between constant amortization and constant payment mortgage? No Google, my friend.
I'm taking notes.
What's the difference, Nate? You would remember.
Constant payment means the payment's the same every period.
The
whereas
debt
constant-
service is the same.
Yeah, exactly, that number's the
Yeah.
same. So the principal and interest payments change, but the actual total payment itself is the same. And then constant amortization just keeps that amortization amount steady, but the interest payments adjust.
As a result of that, what happens to the debt service?
Decrease.
The debt service in a constant amortization mortgage is higher upfront and decreases over time. In a constant payment mortgage, the debt service is constant, just like this. Okay? So now, upon the sale, you have to pay down the outstanding loan balance, 6.142 million. And as a result, the cash flows you have to pay to your lender. There is no prepayment penalty because now you are either, either the new buyer is going to assume the mortgage or you're just going to pay off from the sale of the loan, okay? Now, look at what's happened to the equity level cash flows. You still have a total equity amount invested of 3.64 million. And this is the cash flow, which is this property level cash flow minus your debt service gives you this. Same here, this minus this gives you this. And here you had only 14,782. But your debt service is still 560, so you have a shortfall now. Right? So that is negative 545,685. And in year 5, you have from operations, what was your year 5 cash flow? 802,379 minus the 564,67 gives you 241,911. And this 6203 is your from the sale of the property, which is basically 13,148,766 minus 6,142. Everyone okay with this? So you, Mr. Shi, what are you doing? You look here, no? Don't buy clothes on Banana Republic. This is more interesting. By the way, did you all notice Mr. Shi has nothing on? The only person today, there are two. Sayas, Santa Cruz. But that's okay. And then Rapida. All right. I was not being serious the other day. He knows. The first thing he tells me this morning when Mr. Shi comes in, I was really worried you're going to make a comment on my label. All right. So here with these cash flows, IRR is 15.27. Your IRR dropped, right, from 24 to 15.27 as a result of this. As a result of this shortfall, and also because the duration of your cash flows had increased. Now, let's look at what happens to the equity account balance. All right. So equity level cash flows, operations from sale, this same thing. Now, let's look at the equity capital account balance. So they put in 3.458, which is 95% of the total equity. And this is your beginning equity account balance here. As a result of the terms of the deal, they're still earning 8% on this amount, 276,640. And then you come, this is what they earned, you compare this with this, and you see that you can pay that all of that because this is greater than what they earn. So they can pay them. And the difference of the two gets split 70-30 again. And then ending balance doesn't change, stays the same in the second year, third year, same. Now, fourth year, ending balance becomes the beginning balance at the end of, ending balance year 3 becomes the beginning balance in year 4. And then the case also tells you that this amount, there is, first of all, is there anything called a shortfall? What is a shortfall? Is there something called negative cash flow? There is no real negative cash flow. It's just a mathematical expression of the fact that you will have to bring in the money or you lose your property, right? So you have to fund this. Negative cash flow means you need to find the money to meet this shortfall. It doesn't mean that you can just show it a negative cash flow on your Excel sheet and be done with it. Big difference. You got to find the money, and the money will be found somewhere. The case tells you now the new money that has to be brought in because of a shortfall will also be split 95% by the LPs and 5% by the GPs. And the sum of this and this should be equal to the shortfall. Yes, Taylor. Taylor and then Kevin.
Kevin had a question first. Go ahead.
Why would you distribute capital in years 2 and 3 if you thought you were in need to obviously fund TIs and leasing commissions? Like, wouldn't you just hold back distributions?
You could, but the terms of the deal may not allow you to. Right? The term requires you If you're holding back and based on the way the terms are written right now, what will happen? We will see in the next scenarios. It has a big implication on what you end up losing. Taylor and then Alex.
Yeah, so my question earlier was about your management fee being 1.5% of capital committed. It didn't seem like that included the 518, and I want to know why.
Or which, this is new capital. Yes. So your question is why the 1.5% did not include for this year, you mean?
Yeah.
I think technically it should, but is there a problem with that?
Wouldn't be popular probably.
Is what?
Wouldn't be really popular asking for money and saying no to that.
You are Cuba Gooding Jr. Show me the money. And the guy doesn't, and is asking a fee for it. So you cannot incentivize the other party to increase their shortfall because they can make it up on the fee. It's a wrong incentive structure. So there will be a conversation, right? But, and if at all you need to be paid, you should be paid on the back end, not from constantly continuing to increase your shortfall so you can get additional fee. Big problem. Yes.
I was just gonna say, one of the reasons you might wanna still distribute, even if you knew that there was gonna be vacancy, is because then the accrued but unpaid preferred is gonna get added to the balance and it's gonna compound for 3 years, instead of just,
That's exactly the scenario I was talking about. So we'll discuss it in the next scenario, but you're exactly right. Good point, you're exactly right. Let's see. I want to isolate the scenario so you get a sense of what the implications are. If it sits like each scenario in your mind, it sits separately, then you will be able to see the impact of any one change separately, and then perhaps overlay 2 or 3, and then you can see the combined impact. So this is the shortfall that will be filled by the LPs, which is 95% of the total shortfall amount. As a result of that, what happens here? They still earned 8% of the beginning account balance, which is this. But now they can't get paid anything because this is negative. There is no cash for them to get paid. So they don't get paid anything. As a result of that, what they had earned, which was unpaid, becomes accrued. Does that make sense? Cyrus? And when it becomes accrued, the ending account balance changes. So you started with an equity account balance of 3.458. You brought new money of 518,401, and then you accrued this much. So you ended up with a balance of this plus this is 423,53041. This is your new equity account balance. Is this favorable to LP or GP? When your LP's account balance increases, what does it do for you as a GP?
the preferred return eats it even more into what you'd be able to collect.
Yes, effectively diluting you as the GP. So in a way, this is set up to incentivize minimization of the shortfall, potential for shortfall. Okay? So now, what Alex was saying was, this is your new ending balance, which becomes the beginning balance at this period of time. And then you compare this with how much cash flow is being generated in the second year from operations, 241,911. Since this is positive, there is no new money required to be brought in here. And then, what happens to the preferred earned in this year? Preferred earned would be 8% of this new equity account balance, which is higher than the previous year. So you have to give these guys a senior share of the operating cash flows. First, whatever is left is what you are getting, right? So you become junior anyway. You become diluted. So this is what you earn. And then you compare this to how much cash from operations being generated here at the equity level. This is less than this. So you can only pay this, which is this. and there is still a shortfall. And that shortfall, there's a difference between these two, that is this. And this goes to increase this account balance by this amount, and you end up with the ending balance of 4.351 million. Okay? So now, when you sell the property, you have to pay back the LPs, you have to return the LP's equity, and you have a higher balance to pay them. Now think about this. If you had not had a pari passu situation upon the return of equity, who takes away more immediately? The LP takes away more. LP would want that structure. And you as a GP would want to protect yourself in that scenario. And so that goes back to, we'll come back to all the things you can do. But it's important to understand the logic here so you can decipher the logic from both perspectives and then try to negotiate from that angle. And negotiation by itself doesn't solve the problem. You know, taken negotiation courses? Who has? Okay, so. Why are you laughing? Huh? There's something about negotiation course? It's a good to have course. It's a soft course. Right? Soft course. Yeah, that always depends. Right? So it is not enough. Your real success of negotiation lies in the fact that you are able to understand the financial dynamics and be able to take the financial dynamics and ensure that the way it is written in legal language actually reflects your financial dynamics. Most of the time, your lawyer doesn't have that sense of the moving parts of the financial implications. They conceptually understand. They'll put it in language, but typically they'll put it in language based on what they have done for others in the past. They really can't see all the moving parts and the sensitivities of those moving parts. So you have to play a little bit of the role of the lawyer. If the lawyer is writing something, you will need to ensure the lawyer to explain to you what it means. So you can go back and say, okay, you know what, this is not what I want it to be. This is exactly what I should change the language to reflect what I want to do. That's where lies your success. Otherwise, most deals fall apart. Well, obviously, deal can fall apart at any level. You pay a higher price, deal falls apart. You under budget your capital expenditure, deal falls apart. You take on so much leverage, the deal falls apart. And then you thought you had a deal with your LP GP structure, and you realize that what's written by the lawyers is not the thing you wanted. And the deal not just falls apart, but breaks you apart. Okay? So the whole system is stacked to be against you. But you have to be wise and careful your genius lies in to be able to cut down all those exposures that you have. So that's your ending account balance. For Wildcat, still put in 5%, 182, and so on, then this is 27,284 is 5% of the shortfall, and that equity account balance increases for them, so they do increase a little bit. In terms of bringing in new money, there is no dilution. Think about this. The new money that has been brought up of 545, 685 is split 95 to 5% between the two parties. So that really does not change the relative equity balances of the two guys, of the parties. What does change, however, is the unpaid preferred. This is what is going to kill you. If you are lucky to structure this deal where the LP agrees to giving you 95% of the shortfall, that by itself doesn't dilute you. because your ratio still stays 95-5. But what does kill you is the increase in their equity account balance as a result of unpaid preferred, which arises from the fact that they brought in new capital. Yes, Carter?
What's the alternative to an accumulating preferred?
Non-accumulating preferred.
Which would look like, sorry, we can't pay you.
They literally look like, sorry, we can't pay you. So if there is no money, how can we pay you? You strike those kinds of deals with those who have seen you in your diapers, walked you through the strollers of Central Park, people who love you, right? You can do no harm to them. Those are the people. Yes.
And a preferred return can be cumulative without being compounding too, right?
Yes.
Yeah.
Yes. So let's think over that. Let's finish this and we'll come back to that, okay? So you can have a non-accumulative preferred, non-cumulative preferred, which as a GP you would prefer.
Because you won't get diluted. You limit your.
You limit your downside. Your entire focus should be limiting your downside. Why take on something which you can't deliver? And these numbers grow rapidly. Imagine this doesn't happen for 2 more years. Your equity, you started with 5% equity, by 2-3 years you are like 1% of the equity. Is it even worth for you to continue doing this deal? Right? So this is their ending equity account balance. Now you have operating cash flows. Right? So you have a new structure of operating cash flows. What happens at the end? Why does the Wildcat not receive any cash flow at the end of 5th year? Because there was only 241 generated by the property. These guys had earned 340. They received all of the 241. There is nothing left. So Wildcat gets nothing at the end. Make sense? All right. And then, and here also they get 30-70 of the excess cash flows. Here there is no excess cash flow. All right. So now what happens to the reversion allocation? This is the equity account balance for the LP. This is for the GP. And this is the LP's operating cash flow in year 5. Okay? You ignore the next 2 rows. And now, how much did you have from the sale of the property? You had 6,203,853. So, this 2 is subtracted. This minus the sum of these 2, whatever is left, gets divvied up 70%, 30%. That's how it is. You ignore the row, this row. Okay. Now, as a result, from the reversion, how much does the LP get? LP gets 4,351,373 plus 1,150,237, which is this. And the GP gets the 209, which is the return of their equity, and they get this 492,959, which is 702,243. And then you add this reversion cash flows to operating cash flows, and you get this stream of expected returns. And you run an IRR on this, and the IRR leads you to 13% IRR, 14% IRR for the LP, and the GP gets 35% IRR. Both the targets are not met. So just because of one change in one unexpected change of your client leaving or your tenant leaving, for which you have to incur some tenant improvement expenses, perhaps have no increase in future rents because you are leasing under a tough scenario, and there is vacancy for 1 year with a sizable tenant. As a result of that, the deal would not make sense. Okay? Now, this is isolating that scenario. And you will see that relationship 15.27 equity level IRR, and that principal should also hold here. LP's IRR should be less than that 15.7, and GB should be higher than that. Okay? Now, any questions on this? You guys want to take a break before you want to continue? Continue? Continue, we can finish early.
Are we halfway or?
No, we have a few more to go. We can take 2 5-minute breaks. How about that? Yeah, so let's take a 5-minute break, we'll go to B. I need a break too, huh?
Is there a vending machine in the back?
Yes, it's on the 3rd floor, I think.
Okay, thank you.
Yeah, it is. What's that? Nah, not since Chase. Oh, about Chase? Yeah. I mean, I think I'm walking by, but it wasn't almost ready to walk by it, like, oh wow, August. Wow. Yeah, it's pretty crazy. The, all the photos I've seen, like, from, just like all the things that they had. Didn't have any concerts there. Yeah. Do you want to find like the waterfront, if you go over there?
No, horrible, I'm sure. It's so hard to get there, like, for public transportation wise.
Yeah.
It's logistically not a good spot. Cause of what goes there, like, there's probably not even some beauty.
Yeah.
I think that's gonna be super crowded, given outside of that. No water, no
It's
traffic.
a matter of the Jets were like, on the same day. That was pretty bad.
Yeah, oh yeah, like in April.
Yeah.
information. So the city shouldn't have, the council member, but then the major league ball, the commissioner, MLB, so they basically like push it. It's like, when will the vacancy be on drop this off? So it sounds like we got the loss. But we're not happy. The project will happen.
Vegas?
No, Jack London.
Oh, yeah.
I think that's.
I think that's probably good, I think that's probably good.
Still gets the best. And baseball,
Yeah,
the
yeah.
football's one thing that they found an event, they had.
Right.
He doesn't necessarily agree with the word long term, but I can
Yeah.
see it more of a easy.
Yeah.
Well, I think that was like.
Yeah. Bowling works because it's like 6 games. Yeah, 6 games and also like, even on Sundays, they compete.
I have a question. I work with property owners and developers all the time. Where they would be the GP,
The developer would be the GP.
but the property owner would be the GP along with.
Yeah.
Co-GP.
Right.
Yeah.
And they,
And it's like winter.
they're scared of them.
Yeah.
Right. Oh, it should scare them for other reasons, not just dilution.
Yeah, well,
The other reasons could be, this is the structure, dilution is resulting from the structure of the terms of the deal.
Oh,
Yeah, so that definitely is one of the reasons, but the other reasons is, what is the ultimate distribution of interest? And how is that?
It's from equity that.
Is the developer,
So the 95% of that.
you know, they have a,
Yeah.
because they are
So-
proposing a
so you
development,
have
you are
this
providing the
price,
factor of production.
And then.
So you don't know what the development is, and how profitable
The
it's
equity
going
is
to be.
35.
So you may believe it's going to be worth 100 million, and you get your 20% share, or 30, whatever the value of the contribution is getting in that. Yeah, that's what's profit, 200 million. So how do you reconcile that? But it's still easily resolved.
But it's all of that.
Yeah.
Well, the first one took a long time to set up.
It doesn't have to be grounded, you can still go.
The subsequent ones get heat.
Doing the right kind of a negotiation. You still can. Yeah, yeah, I mean, obviously the reputation of the developer matters. You should call up, you know, you have to do your due diligence on the developer, their ethics, how they dealt with previous partnerships.
There's lots of like,
Like, you should talk to their former employees, they will tell you what happened.
You know, I do that next step, but it's just like,
So-
gonna do 5 on the time.
Thank you.
Oh, I have a separate sheet. for like the alcohol. You know which scenario?
Yeah, 2A, or, yeah, the one where it's not.
Because I think they come to the agreement, $8 or something.
Right.
Or whatever. And then I think this is, and then they took the no increases. Something like this. But then it's just this column right here.
You just sum those.
Yeah, this is
Not back yet.
This is 18 times, the 18 times.
Kevin and
Taylor.
Taylor.
And then this one is, yeah, this one is easier to watch out for businesses, because these are all 2% increases, right? This one says, this one is 2% increase. So you Yeah, yeah, yeah. I agree. Just like this. Yeah, yeah.
Like, it would be cool because it's all like.
I would agree.
It's not.
I've been following. I haven't been to play. Really?
Yeah.
I have that.
Actually, no. I honestly, it was like a, was it a?
Who has the sign-in sheet?
I did.
Has everyone signed in?
Yeah, yeah.
Let's wait for Kevin, he's the only one missing, right? All right, let's get started now. Okay, so now, let's go back to something that Alex alluded to. This is the same scenario. Rather than moving on to the next one, let's deal with this a little bit more. In this scenario, there is a shortfall. And that shortfall is unforeseen. As a result of that shortfall, you have to bring in some additional capital as the LP, because the shortfall, you have to bring in 518. And obviously, there is a general recognition in this room that that conversation is not going to be an easy conversation. And obviously, as Taylor said, you know, should they even be paid on management fee on this new capital, right? So let me ask you this. Let me ask you this. What could be, how would that negotiation follow? When, first of all, you make a capital call, what is called a capital call, right? So you're making a capital call, and capital call is just a letter that needs to be sent to the investor. Sent usually 15 days before the money has to be deployed. The original LPGP agreement stipulates that the capital has to be provided by the LP within 15 days or 10 business days of the capital call letter is being issued. It could be issued by fax or by email or hard letter. What if the LP decides not to fund it? What happens then? Yes, Taylor?
Couldn't the GP make them take out a loan with them?
With them.
Yeah, at some like agreed.
Right, but many of these things you have to estimate now when you are dealing with your initial LPGP agreement, right? If it is not in the agreement, then imagine what will happen. LP will say, what the heck, why should I bring in this money? There was no provision for it. So you have to find a way to include these potential unexpected changes upfront. There is always, your normal agreement will always account for force majeure, which is unnatural or unexpected natural causes. Something which you cannot do anything about, like there is a meteor falling in Siberia, forest gets burnt, your property was part of it, there's nothing you can do about it, right? But here there could be, this is in the area of your expertise, your realm of expertise, which is basically you know how to operate this property. You thought that the lease will work, there will be no vacancy, but all of a sudden there is vacancy and there is this situation. So how would you deal with this unforeseen or unexpected situation which could arise in the future, right? If we're dealing with it you are dealing it with this whole perspective in a way to hedge your losses, protect your downside. So the conversation could be, let me propose something. You know what? There could be unforeseen shortfalls, which we would like to fund 95, fine. If at that time you are not able to fund this, Mr. or Miss LP, what should be the consequence upon you? Or should there be any consequence?
The dilution of their share. If the GP has to fund it, then
Only by the funding amount?
You probably want a premium for the opportunity cost of how to deploy the extra capital.
Sure. All good. If you have a capital account balance and a capital call issued on that, on top of it, and there is no other mention of shortfalls, and the LP cannot fulfill the capital call, it can have a tremendous penalty on the LP. It will not account as an additional capital, it's just a regular capital call. You committed, and if you can't fund it, the LP can lose up to 50% of their existing capital invested in this, that 3.458. Half of that can get wiped out. And when that gets wiped out, who does it accrue to? To the benefit of the GP. So as an LP, you have to be very careful. When the document says, if you cannot fund your capital call, and you have a 50% protection, 50% loss of your equity, then you have to very clearly say, tell me the situations in which this could happen. Not all capital calls are the same. A capital call related to an investment project where you're all comfortable with this investment, you go ahead with it. Or a capital call which is unforeseen, perhaps because caused by the callousness of the GP. They're two different things. You've got to protect yourself, otherwise you get blanket wiped out. The second, this conversation, even if it is drafted in your original agreement, what would this be? Do you think the LP will agree to 95.5? You told me you show me the money, why should I put 95.5? If there is a shortfall, maybe I'll agree to put 25, you put the other 75. Your argument would be, where is my money? Where do I have the money to put this? And then they say, okay, fine, we will try to fund it, but we will extract something out of it. Because this was unforeseen. So you put this, we will agree to putting this money, maybe some amount of this money. Not necessarily 95.5. But we will earn, instead of 8%, we will earn a 12% preferred on this new money. There should be some consequence for you, Mr. GP, for not delivering on this. How else can I make this as an LP? As an LP, I can say, here you were, because of, now it is 12% on this, so the unpaid amount accumulated, which is arising because of this shortfall, that amount earns not 8% but 12%. And they will also ask, they will say, this was getting accumulated over 1 year, right? Gets added to the balance, and the next year we pay, next year equity account balance is this much. Of this, we earn 12% on this amount and the rest 8% on this amount. So our earned preferred is going to be higher. And by the way, our preferred was being earned on an annual basis. This 12% compounding should be on a monthly basis or a daily basis or a continuously compounded basis. Is there a difference in the yield? Large numbers can have a big impact on the yield. Yes?
What's the difference between monthly and continuously compounded?
You tell me.
Sorry?
You tell me.
I'm asking.
Your credit card tells you you earn a 12% interest per year. You pay on your borrowing, which is your R, 12%, right? But the credit card has in the fine print says, you know what, that 12% interest is going to be compounded monthly, right? So if on the one hand you're thinking you're paying 12% interest, but effectively, because it is being compounded monthly, your actual interest being paid is 1 plus 12% divided by 12 to the power 12 minus 1. Is that correct? That's 1. Huh? 1 plus E1. Figure it out. So this is like 1%, so 1.01 to the power 12 minus 1. That's right, right? So your number would probably be higher than 12%.
Yeah.
Right? When applied to large dollar volumes,
Sure.
this can be a huge number.
Mhm.
So what was your question?
So what's continuously, what does that mean?
Continuously compounded means your e to the power RT. Your dollar grows at e to the power R. E is the natural exponential, which is value is 2.718. R will be 12%.
What is 2.718?
That is the value of E. It's a natural constant.
Yeah.
My friend, you're from France originally, huh? How can you not know E? Frederick von Gauss was a French mathematician who came up with this.
I was a history major.
So all the more reason to study the history of mathematics. And also you had a wonderful guy, his name was Euler. I don't know if you remember Euler. French mathematician, great traditions of French mathematics. What a lost generation. So he came up with this, e to the power I phi plus 1 is equal to 0.
Okay.
This is considered one of the most elegant equations in the world. Why? Why? Think about it. This was my Euler, huh? These are natural constants, 0 and 1, right? Everything in the world, 0, 1. You know, E is the natural constant. It occurs in nature everywhere, especially in growth, where there is a growth like the structure of galaxies and everywhere. E is there. I is what? I is the square root of 1, imaginary number 1. Square root of minus 1 equal to I. Pi, you know, it's common constant, natural constant everywhere in the world. So he found a way to link the 5 natural constants into this simple, elegant structure of such an amazing, simplifying power of mathematics. So that is the tradition you come from. I don't know where you got lost, my friend. Huh? So E is that 2.71. The value is 2.71. It is so if your growth is like this, right? E to the power x, something grows, it just goes like this. When you x is 1, it will be here, 2 will be here, and so very steeply it grows like this. Exponential growth, the fastest possible growth. So as you increase the frequency of compounding, the number increases with the increase in frequency, but the rate of change decreases. So the level of the number of the EAY will 12, little higher than 12, right? So as you increase the frequency of compounding, it will increase. But the rate of change, the delta between each of those changes is going to decrease over time. Okay? So that's what this means. That is continuous compounding. And your lawyer will say, your preferred, unpaid preferred will grow, will compound at a continuously compounded rate. Right? So now it depends on the intelligence of the other party or whether they can figure this out or not. If not, and you never went to Shaq and figured this out, especially E, it's still time, Alex. With a $100 million deal, you can end up paying like a $2-3 million more. What happened? And imagine this function. X to the power x to the power y. Even faster. But in a one-dimensional space, one x, if you ignore y, this is the fastest you can grow. So money can grow on a continuous compounded basis. That is the highest speed of money that you can grow. Okay? That is effectively what is called the limit of your growth. Okay, Kevin, you're saying something? No? Alright. Alright, so now, that conversation will be, we increase the frequency of your compounding on the preferred. That kills you right there. And how will you protect yourself? You will say, wait a minute. You know, we know that you want such a deal which is so onerous to us. But at least we will have the right, we should have the right to be able to fund it ourselves, if we can. We don't want to forego that right. And if not, we don't have the money and the cost of your money is so expensive, at least give us the opportunity to go out and borrow money. And we can share the cost of the borrowing. And allow us to pass the cost of the borrowing to the investment. Borrow money from a third party at more reasonable terms. You cannot forego, if somebody is being extremely onerous upon you, then you have to find ways to mitigate that. So you don't end up in the most onerous situation, you have all the flexibility to do other things. Right? And the ideal scenario would be what you said, non-cumulative preferred, that's the best. This will be required by an institution. But friends and family will do it, they will not worry about it, okay, it's now 1 year, 2 years. But investors like cash. I'm sure you're working with, right? Private investors? Private investor gives you some money, you buy a property. What is the best thing you can do to keep them psychologically healthy? Give them a little money every year. If they don't see money every year, they will be breathing down your throat. So it's like, you give the pacifier to a child. You have to give them some money. If some investor doesn't see cash, they just panic. Yeah, you agree, Cyrus? Problematic. Look at your 401k statements. If there is not a slight increase every year, you panic. Okay. That conversation is not good. What else can you do? So you reserve the right to fund it with debt, you reserve the right to bring in your own equity, or you reserve a right to go to a third party to fund this. And if there is a complete shortfall, what else can you do? The property comes with land. You can use land as a financing tool. You should retain the right in the event of unforeseen shortfall to rectify the situation, that you can sell the land to a third party and lease it back to raise some cash to fund your shortfall. Right? The more flexibility you give yourself, the more you will protect yourself from the downside. The higher the rate at which this unpaid preferred grows, the faster the rate at which you get diluted. This is very dangerous. As I said, this distribution may not be that dangerous. This new money may not be that dangerous. But this can be very dangerous. Committing yourself to a cumulative preferred with a frequency of continuously compounded payments at a higher rate than 8%, maybe say 12%. Right? That goes your deal. You will have no property. You will have nothing to show for it. You spent 8 years doing this. Why, you could have done so much better. Go, I have read a book somewhere, a couple of books, beautiful books, maybe. So, all right. All tenants renew according to benchmark assumptions. 2B. However, due to continued weakness in commercial property demand, Wildcat holds the property for 5 years. During this period, Wildcat makes capital expenditures of $500,000 in year 2 for a new roof and $150,000 in year 3 for new parking lot. So how does the cash flow looks? Yeah. Nothing changes. It's still a 5-year hold. You lease the initially vacant space in 3 years. Not sure does not leave. So that's not the scenario. All the difference between the previous scenario and this scenario is that because of the new roof and the parking expenditure, you need to incur some new capital expenditure. And as a result of that, you run the numbers again. Same thing we did as before, except this is the new thing. And your property level IRR is roughly 11%. Okay? Property level IRR, if you see, has not changed much. It was 10%, 11% in that range. When the property level IRR starts to move, a big problem. Should not be very sensitive. Okay. Now, the debt has not changed, so same, debt calculation stays the same. And before tax cash flow stays the same. Here in year 2, however, you see there is a shortfall of 149. Equity IRR has fallen. Still better, is fallen to 17%. Okay? And then look at this. Investor capital account, because of the negative cash flow here, they have to bring in some money, right? 95% of this. And whatever is earned and not paid gets accumulated. As a result of this, next year's account balance goes up. Next year's preferred earned increases. Next year there is a shortfall also, so there is the accrual of the expense next year, unpaid preferred next year also. And this becomes the new equity, and then it finally works. Right? Just because of unforeseen capital expenditure of $650,000 in 2 years. Is this equity account balance at the end greater than this? 4351. $3,912. So this is less. Okay? So now, there is Wildcat's equity contribution and so on and so forth. And here we did the same thing, and IRR focus. It still doesn't work for both the parties. In this scenario, we have isolated. We have not said there is any tenant vacancy. What we're saying, there is tenants is still fully leased, but your capital expenditure was not budgeted. Because ideally, when it is being budgeted properly, then you should have included it in your estimation of your investment value at the time of the purchase. and fully disclosed it. Right? If it is in a reserve account somewhere for budget, then it qualifies for capital call. Otherwise, there is again this drama of risk getting, who should fund this, who should not fund this. Assuming you have built the flexibility for yourself, you actually find a way to fund it, but still, doesn't work for the parties. Right? This is isolating the capital expenditure. As I said, most deals fall, purchase price, overpaid, underestimated capital expenditure. Question 2C. After more careful observation, underwriting, the life insurance company offers more careful underwriting, the life insurance company offers a different LTV. Instead of 65%, they're offering you 60% LTV, 7% interest rate. So effectively what has happened is the financing market has changed slightly. Now we can isolate the impact of the financing on the returns of the parties. Okay? And you assume a 3-year holding period. So now property level IRR based on this 3 years. This is similar to the base case, right? Base case was also 3 year. This is similar to the base case. We forecast for year 4, calculated the exit value, and this is 4.25%. How much was the base case? 4.32%. Why is this 14.25%? Why is this less than the base case at the property level IRR?
It's the same thing, it's the asset management fees.
Yes, because what has happened to the asset management fee?
The total equity contribution's gone up, so.
Yeah, so asset management fee has gone up, which is being deducted from here, and therefore the returns have gone down. Property level. Okay, so the next step is again debt service impact. What is going to be the payment to the lenders? Again, 3 years, so there's going to be prepayment penalty. Now, this prepayment penalty, by the way, I said 3 years, right? 3% of the total unpaid balance. What if it is yield maintenance? For yield maintenance, you have to do a whole set of calculations. The yield could be, what was the rate of debt on this? Let's say 6.75%. This is like a different case, 7% here. So, by giving a 3% penalty on an outstanding loan balance, you're effectively saying that you're paying 3%. But yield maintenance is not just that 3%, but the difference between the 7 and what you will put it into a risk-free account, what you will get, that over a time period of between years 4 and 5, 2 years. Okay. Right. So here we did the equity IRR 22.6. Why did the equity IRR? Did it go up or go down relative to the base case? It went down. Right? Why did it go down? What was the base case equity IRR? 24 point something.
You're using less leverage.
Yes, so you're not benefiting from the financial leverage that much. Slightly less.
And the rate is higher.
Yeah, rate's a
Yes.
point higher.
And the rate is also higher, 25 basis points, yes. Okay. So you do the same, operating cash flows, investor capital account. What happens here? Need to see. Now you brought in more equity. Instead of 3.84, you have to bring in 3.952 equity because the leverage is 60%, not 65%. Right? As a result of that, you are earning 8%. That is what you earn. Then you compare it with how much property is generating. So property is generating less than that, and therefore you have a shortfall. And because of the shortfall, their LP's equity account balance is going up. And therefore, in the next year, their earn is going to be higher and you have to pay a higher amount in the next year. So isolating the impact of the more conservative capital market or availability of financing can lead to lower equity level returns and also to further dilution for you because of cumulative preferred. Okay. And then wildcat account is 208 stays the same, operating cash flow, and you do this again, and you see your IRR. Now, it barely matches the need of the LP, but as the GP, you are still okay. You would do the deal. But because of this slight change, right? And here it tells you that not so much is going away from the GP, but it can really impact the LP's return. Right? So if you are working and underwriting this deal, so it's not just underwriting of the pro forma of that, of the transaction of the property, but also the structure of the deal also. Right? Without the structure, the whole thing is incomplete, yes.
So because we changed the leverage, the investor level cash flow changed? I thought we were saying that the effective.
Yes, it did change.
I thought we kind of said that the effective leverage doesn't benefit the investor.
No, it changed slightly, right? So what is the base case IRR for equity? Yeah, so it's slightly changed, right? So the point here is, they will be, because what was it for Wildcat? 70 something?
Right, 71.
71, right? So it came from 71 to 63, but still is greater than what their expectation of 50% to do this deal. What will it take them to do the deal? But this barely meets that and will probably not work for them. So now you can go back to the bank and have a different set of conversations, right? At the end of the day, you want to deal work for both parties. But that general principle that the benefit of leverage mostly accrues to the GP holds. Now 2D, this is interesting situation. Up until now, the scenario has been that the LP gets a preferred return of 8%, right? And excess distributions over that 8% are divided 70-30. In 2D, we have a different structure. And that structure is called not preferred based, but IRR based. IRR based metric of whether this deal works or not. And specifically look back IRR. So let's see what that means. In this scenario, the outside investors are nervous about the economic environment. As a result, they demand the following investor-friendly changes to the waterfall structure. Assume a 3-year hold period. Outside investors will provide only 90% of the required equity instead of 95. You bring in 10. And instead of 8% preferred, they will get 10% preferred. Outside investors will receive a 12% IRR preference. %10 preferred is not enough. You give them 10% preferred, but you also give them an IRR preference of 12%. And we'll see what that means. This means that a reversion after invested capital has been returned to the outside investor and to Wildcat, the outside investor will receive additional cash until they hit a 12% IRR over the lifetime of the investment. Remaining cash flow will then go through the promote. Cash flows in the promote structure will now be split 80-20 in favor of LP rather than 70-30 as before. Okay? So let's look at this. Here, 3-year holding period. Now, because it's 90% equity, so the management fee goes down. So which is a slight reduction here, and we get a property level IRR of 14.34%. Right? Everyone okay with this? Okay. Then we do this. We go back to the 65% LTV and 6.75% as we had in the base case. And we run this. And then we calculate the cash flow to the equity, which is 25.04%. Okay. And then we look at the investor capital account here. And the investor's equity account balance is 90% of this rather than 95%. So 90% is this amount. And this is the ending balance, which is the beginning balance in this period. And now there is no shortfall, therefore there is no new money being brought in. And then 10% of this is your earned preferred. But the property is only generating this much, so you can only pay this much, which is this. So there is a shortfall which is accrued here. So the ending balance is this plus this gives you this. Okay? And this goes up here, and here you calculate 10% of this, which is this. You compare this to this. This is less than this. Therefore, you can pay all of this. And the excess between these two gets divvied up 80-20 rather than 70-20, 70-30. Okay? So ending account balance, and you come with the ending account balance for the LP at the end of year 3. Wildcat contributes 10% of the equity, which is higher now, 364. And they don't receive preferred. Operating cash flow gets split 80-20, so this is your operating cash flow distribution. Okay? Now, reversion allocation. When you sell, I'm going to just write, makes it easy for me to explain. Okay. So this is your equity account balance for the LP. When you sell the property, you have access to this much cash. Right? From this, you have to pay. This is all the cash available to meet whatever requirements you have upon sale. Whatever requirements under the structure of the deal, terms of the deal. Okay. But now you have an additional requirement which basically says that any excess cash flows that were previously being distributed 70-30 after the return of the equity account balances of both the parties would now change as follows. You have to, once you pay the equity account back, then the LP has to be guaranteed a 12% IRR return before the money can get divvied up 80-20 in terms of cash between the parties. Okay? So, the first thing you have to do is figure out how much cash does the LP need to get in the year, at the end of the year of the sale, for them to get a 12% IRR, right? So how would you do that? You go back and see, this was the operating cash flow for the LP, right? Right? So you say, you look at this row, just this row, last one. If you were to, they invested 3276, which is their share, 90% of the equity, which is there. In year 1, they received this much, 279,685, and year 2, they received 349,189, which is this. So they got these two payments. How much total money do you have to give them in the 3rd year in order for them to get a 12% IRR? How would you calculate that? If you don't have Excel, how would you calculate that? If you're in the movie Alive, in the middle of the Andes with nothing but your broken plane and dead people. Yes, Carter?
What I was gonna say was the amount that they put in originally times 1.12 to the 3.
Okay, so they put in this much. Okay, what you're saying, take the future value of that.
Yeah.
But that's only part of it, because you already have, they have already, they, you know, that you can pay them this, right? So how will you do it? Logically, not Excel. Anyone? Mr. Yu, Mr. Shi?
Just use NPV.
NPV?
Yeah. PV equals to PV is the investment amount, and you just discount it every year's amount that's actually present value.
Okay.
That equals to the investment amount, and the R should be the 12%.
Yes, yes. Alex, you were saying the same thing?
Sure.
No, tell me now. What were you saying?
No, I was gonna say the same thing he said, but you subtract, the distributions from year 1 to year.
Yeah, I think that's what all of you are saying, the discount rate. So let's look at this. This is your value today. Now, there is a future value of this. What will be the future value of this? This number, let's say x1 times 1 plus 12% to the power 2. 1, 2, future value, right? Of this amount that you receive. This future value would be x2 times 1 plus 12% to the power 1. And let us say this is x3, the total amount. So this would be x3. And the sum of all this is y. Or basically, let us say, right, y, this is x3 plus y. Right? And this whole thing should be equal to the 3276000 times 1 plus 12% to the power 3. Right? So you know why, because this is given. x3 you can calculate, so x3 will be minus 1. Does that make sense?
It's gonna be hard to do on a deserted island.
You'll be surprised too, Carter, you'll be surprised. The more practice you do, it becomes natural. And even if you don't get the number calculation right, at least you get the structure of the logic. That is the key. So you can calculate how much money you got to pay, which is this number, 3860621. All right, so what is the next step now? You figured out in order for your LP to get a 12% IRR, this is how much you have to pay. By the way, you can also use this, do this using goal seek, right? Everyone familiar with goal seek function? Okay. Now, so what does this mean though? This means that they should be receiving this amount in the last year to get them to 12% IRR. And a part of this is the return of capital. So you have to check this number against this number. The value from the sale, the net sale proceeds from the property upon sale. If this number is less than this number, then you know you can pay all of this amount. If not, whatever amount is here will all accrue to the LP. Okay? But in this case, this is less than this, so you know you can pay it all. So what does this include? This includes, it should include this, the amount of equity that will be returned because you're selling the property, so that money needs to be returned. And this should also include the operating cash flow these guys are getting in the last year. If you add these up, right, let's say this is x1 and this is x2. So the difference of this is what? X2 minus X1. This number, whatever that number is effectively this thing. That is the additional amount of money you have to pay the LP from the proceeds of the sale after returning their equity and ensuring that they get back their operating cash flow in year 3. There is still that difference of 128,000. That 128,000 is the number that gets them to the 12% IRR. So that is the money that has to go first to the LP. So therefore, after that payment, whatever is left, so this was the amount of money they had, right, from the sale proceeds. Brenda, is that okay? So from this amount, let me write it here, 5810,226. You have to first pay 3323915, right? And you have to pay 364, which is the return of the equity for the Wildcat guys, right? They should also get back money from this, provided this money is greater than this. Yes? Yes, no? Yes. If this amount of money is less than this, then Wildcat guy doesn't even recover their equity. But because this is more, the Wildcat guys can recover the money from this to the extent it is more, right? So that's what this is Wildcat's equity, this is GP equity, this is LP equity. And then, what else do you have to pay? 128,566. This is additional payment to meet 12% IRR. Right? So whatever that number is, let's say X3. That X3 gets divvied up 80% of X3 is this number, and 20% of X3 is this number, this number. Does that make sense?
Is there a scenario where Wildcat doesn't get their operating cash flow for that year because the GP equity has, needs more capital?
Operating cash flows are separate from the sale cash flows. So to the extent operating cash flows don't exist, there are not enough operating cash flow, then the GP will not get anything. But it also depends on what happens, because the GP and LP are sharing in the excess cash flows. The LP is getting a preferred, and whatever is remaining is being shared on a pari passu basis. If you had a situation where it is not pari passu and the LP has the, still gets their first 70% first, and there is nothing to pay the Wildcat guys, they will not get anything. So that's why the seniority becomes extremely important in how you construct it. All right. So any questions on this? As a result of this, you run this. This is the money they are all getting, and you do the IRR. Now it works for the LP because LP is getting a guaranteed 12% look back IRR as a senior basis. And the GP is taking whatever is left, so GP returns don't matter, it works very well for the LP. Right. This is a different deal than what we had before. In the other one, you had a preferred return deal. This is an IRR deal. Okay. If not, no questions on this, I'll move forward. Then this question 3, 2E. Is it okay to erase this, my friends?
Yep.
In this scenario, the LP investors want to structure the deal similar to the terms stated in 2D, which was before. However, instead of agreeing to the previous blanket 80-20% split of the excess cash flows from the sale of the property, they would like to offer the GP a promote structure that rewards the GP if they can help the LP meet certain IRR hurdles as follows. So, this makes it a little more complicated. And this is what it is. Up to 12% IRR for the LP, LP will receive 100% of the excess cash flows from the sale of the property, and the GP will receive nothing. GP is not entitled to any catch-up IRR. Now, what is catch-up? Yes, Alex?
After the LP gets the 12%, the GP eats the remaining cash flows as much as it would to hit a certain IRR.
Why would you have that?
To guarantee some sort of minimal return for the GP.
Yes, when you structured the deal, the GP did not get any preferred return. But GP did invest capital in the deal. So the GP's argument is, yes, you get your first 12% IRR, but then we will catch up till we get to that hurdle, whatever that catch-up hurdle is. Okay? But in this case, we are ignoring catch-up. And then from 12% to 15% IRR for the LP, LP will receive the first 80% of the excess cash flows, and GP will receive the 20%. Then from 15 to 18, LP gets 60%, GP gets 40. 18 to 20, 40% to LP, 60% to GP. And above 20, GP gets 20, and everything above that goes to the GP. Right? This is more typical, especially for larger transactions. Yes, Taylor.
So like really stupid question, but
There is no stupid question, my friend.
so the last one was 80, right? Because in the model it seemed like it was 100.
Which one? In the last one, it is saying after you give them the 20, everything else goes to the GP.
So 80. Their share is 80.
80% from up. Just tiers up, 40, 60.
Yeah, no, the model. That was, well, I guess.
It says 100% of the remaining, that's how it is,
Mhm.
maybe set up, yeah. So let's look at that. What happens to the reversion allocations? Right? This is similar to 2B. We had the same number that needs to be given to get them for a 12% IRR, 12% look back, right? So we ensure that they get this, and we calculated how much they should be given to get them to 12% IRR. And then we compare it to this total amount of cash flow that is available, right? Because there is no catch-up, between 12 and 15, how much should be paid to the LP in order to get them a 15% hurdle? 18% hurdle, 20% hurdle, and above 20%, all of this money is available, right? So then we calculate required GP investor cash flows to catch up IRR of 12%. Why is this 12%? Oh, but this doesn't apply. One second. Okay, so look at this. So we calculated how much money needs to go to the LP to get them to these levels of targets, IRRs. So the difference between these is what they will have claimed for every hurdle. Does it make sense?
Mhm.
Cyrus? Kevin? Okay. So let's say the difference between this and this, the amount, this is greater than this, right? So in order to get them to 15%, they will have to be at least paid the difference between this for to get them to 15%, and so on and so forth. Okay? Therefore, here, upon equity reversion, up to 12% LP gets 100% of the share of the cash flows. So which is basically saying we pay you 128,566 more to get you 12%. Right? And then to get you from 12 to 15, if there were 15, then you would get 80% of the difference. That difference we calculated here. And so on and so forth. Whatever is left, you get 20% here. And then here, the distribution is accordingly. For the first 12%, the GP doesn't get anything. Between 12 and 15, they get 20. 15 and 18, they get 40, and so on and so forth. And the remainder goes to them. So the test here is that the sum that the LP gets and the GP gets, that should add up exactly to this. 5810226. Okay? And therefore, as a result of that, you can do the IRR. And here, the LP IRR is 18.6% and the Wildcat IRR is 63.3%. Okay. Yeah.
For the cell where it's cash flow required for GP to catch up on IRR?
This one?
No, back, same sheet.
Yeah.
So just the formulas on 2 of the.
There is no GP, there is no catch up to the GP, that's what
Okay.
it's saying. So therefore this is 0.
So for the last one, 822,
Yeah.
how do we come to that exactly?
This is basically whatever is left after you have distributed all this and this.
Okay.
Whatever is left is this. This gets you to back to this reconciliation with the total amount of cash that's available from sales.
5.8 minus 4.
Okay. Okay. So that is that scenario. Let's move to the next one. In this case, we are saying that there is a catch-up for the GP. And the GP is entitled to receive a 12% IRR catch-up after the LP has first received 12% IRR. Please explain whether this scenario is better or worse off than GP than in scenario 2E above. Okay. So we did the same thing. We identified in order for us to get to the GP at 12%, how much we need to pay them, right? And that is this number. They invested this much, and there was a shortfall in the first year, they didn't get anything, this was their cash flow. So if you account for this, if you pay them this, the GP will get 506,638 in the last period in order to get them to a 12% catch up. But a part of this is the return of equity, which is 364,000. So see here, catch up to 12%, they get that difference. The difference is this minus this 364. They get the 364 and 123. This 123 gets them to the 12% IRR. Okay? So now, there is one thing unique is happening here. Here the catch-up is from the sale of the asset. Right? Now if the holding period instead was 3 years, it was 8 years or 10 years. As the LP is getting money, the GP could regularly catch up with them. Also, this is a simplified scenario, but in a more complicated scenario, the GP will catch up with them from time to time. And their catch up may not be to the 100% level, perhaps 50% level, or some other level which is not 100%. Yes?
So in this scenario, there's no prep return though.
For who?
For the LP. It's just they're guaranteed a 12% IRR, they're not getting an 8 pref.
No, they are getting a prep, right? This is a scenario which is similar to as to E, where they're also getting a prep. right? So as a result, you're only incrementally paying them 128. This is exactly the same as 2D,
Okay.
right? And then you work out the cash flows, and you know their cash flows. So effectively, in terms of IRR, nothing changes. Because the catch-up is coming at the end.
Mhm.
If the catch-up was coming sooner, then the IRRs will shift, okay? But this, even here, this scenario is different than the previous scenario, because here, even though IRR numbers do not reflect this, the fact that the GP is getting a catch-up before the money is being distributed, although it is not being reflected in the IRR calculation. IRR calculation is not catching that. This scenario is better for the GP than the previous scenario. Because excess cash flows are only being distributed after the GP has met the catch-up, has been provided the catch-up. Does that make sense? No?
No.
Well, you get your LP to 12%,
Mhm.
and in the previous scenario, there was no commitment on your part to get to the GP
Right.
to 12%. And whatever money was left was being divvied up.
Mhm.
In this scenario, you're getting the 12% to the LP, and then you're catching up the GP.
Mhm.
And then whatever is left is being distributed amongst the parties. So which scenario is better for the GP?
Obviously the catch-up.
The latter one.
Right.
So that's why, even though it's not reflecting in the IRR, because the timing of the cash flows is same.
So that's my question. So is the catch-up at reversion?
In this case, it's at reversion.
Because obviously you wanna have the higher IRR because you're getting a greater portion of the promote, and then your multiple will be higher.
Yes. 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 Okay? Yes, Carter.
So you, with the, when this catch-up is instituted or included, you can argue that the LP's 12% IRR, you know, is the most likely outcome.
Yes.
Even if it's a marginally home run deal, they may still be at that 12%.
Yes. But after what happens after the LP is 12%? In 2F, immediately after LP gets a 12% IRR, the GP gets a catch-up. In 2E, LP gets the IRR 12%, but there is no catch-up. The cash flow is distributed. Because of the catch-up, the GP gets a seniority over the excess cash flows. That's why this 2F scenario is better for the GP than the LP. Okay? All right. Now, 2G, this was just trying to show you isolate another thing, which is basically to say, now your sale price, instead of an 8.4 cap rate, it's 7.4 cap rate. So you have, the value has increased, or cap rate compression. So we did the same thing, you have more money available, and you have 80-20 distribution. So as a result of that, your IRRs look a lot better, even under the hurdle structure with the GP catch-up. Okay? And then 2H, here it's slightly different. Let me say one more thing, which is, I forgot my chain of thought, but that's okay, we'll come back. This scenario is exactly the same as 2F, except that now it must be assumed that the LP is a foreign investor. And the LP's investment in this project is converted into US dollars at the time of the purchase of this property. So their equity immediately gets translated into US dollars. But subsequently, after the investment, the dollar depreciates by 15% relative to the LP's domestic currency. During each of the years, the property is owned by the LP-GP partnership. So the domestic, the US dollar depreciates by 15%. Some other currency, let's say the euro, appreciates. Model the returns for the LP and GP in their respective domestic currencies. So what happens? This all remains the same, but we have to go back to this place, here. Right, we calculated, this is in US dollars, right? The cash flows, nominal cash flows in US dollars. But then what we did was, we said, this is the units of the domestic currency or relative to the US dollar. So 117 to a dollar. This seems like more like Japanese yen rather than euro, right? So because of the depreciation relative to the, because of the depreciation of the dollar relative to this currency, at the time of investment, 117 foreign currencies could buy $1. Now, only 99, because of the depreciation of the dollar, 99 units of the foreign currency can buy $1. So the foreign currency is becoming stronger, and so on, so forth. There is a 15% devaluation of the dollar every year. So what happens? You see the cash flows, you convert them into the local currency, right? For the LP, foreign LP, local currency, and you convert them at the new conversion rate here, right? So the cash flow that will accrue in this year, if it is paid back to them, it will be at this rate, paid back this rate, and when they sell, whatever cash they're receiving in dollars will be converted at this rate. So as a result of that, because of the depreciation of the US dollar, their returns fall significantly. Right? And what happens to Wildcat's cash flows? Does not matter because it's in US dollars. Okay? And therefore their multiple also drops relative to Wildcat's multiple. Okay? So now, how can you expect, what should we, how can you forecast if the dollar, how is it going to behave? The foreign currency is going to behave relative to the dollar. Right? There's no way to forecast. You've got to find a way to hedge it and assess what the cost of hedging is. If the cost of hedging is manageable, like, it's okay. Otherwise, what do you do? You let the GP manage their own money, right? If this GP is a Korean or a Japanese large pension fund, they do macro hedging at the top. Right? So this will be like a bucket in the drop of what they're managing. So they will hedge at that level and bear the costs at that level. Now, if they're a smaller pension fund or a institution, what happens then? They said, you know what, Kevin, I gave you this money, I was expecting a 15 or 20% IRR, I'm getting 7.8%. What would be your response?
I can guarantee returns in local currency, but.
Yes. It is not my expertise. My expertise is real estate. My expertise is not currency risk management. Right? So if you are astute, what Kevin will do, he will say at the inception of the fund, my returns will be measured in dollars, not in your domestic currency. That's all I can guarantee. I can guarantee what it's in my control. And I will only denominate the fund in dollars, and whatever risk associated with that is up to you. You take on that risk or not. If you can hedge that risk at a reasonable cost, that's great. If not, you are taking on that risk. It's not my responsibility. That would be the astute thing to do. What else can you do? Well, there should be, you can identify your investment in certain secular pockets where there is a secular increase in the value of the underlying asset. So let us say you buy land in Mumbai, for example, right? Mumbai land will typically appreciate by 5 to 10% every year just because land is scarce and the rupee is depreciating, and as a result there is more inflation. So and rupee is depreciating, and the depreciation matches up, or the appreciation of the land matches to the depreciation. So you can make an argument in a secular scenario just by virtue of us buying land in a place where it is scarce, And we can expect, looking back at 25, 30, 40, 50 years, that there has been a 5% appreciation of the value of the land every year. And we notice that the depreciation of the currency is also 5%. So we have constructed this hedge. That's all we can do, right? Other than that, you don't take on the risk and say, you know what, you should never guarantee the returns. In fact, you should ensure that your returns are measured in the currency that you can manage. It's your currency. You can do other things like we saw in Heinz, as we saw in Equity International. Right? You can time the flow of, right, for these guys, you know, if they appreciate, if they expect a depreciation of the US dollar, so they convert upfront. Depreciation of the US dollar means they only minimize the outlay upfront, and they buy more US dollars going forward. So they will time their cash outlay to match the construction schedule. So their objective should be, if the dollar is going to depreciate, we don't take on, we try to minimize the cash outlay conversion anyway, and we try to get as much out of it as soon as possible. Right. Now, what goes into you assessing whether the currency will depreciate or not depends on a whole bunch of factors. Right? In euro, Germans will never let the euro depreciate because they don't want the money to be. It's a German experience of hyperinflation, and the French should be so grateful for it. It's a different model. What we do here, whenever there is an economic crisis, we pour money into the system. And it works. You can't fight the Fed. Is there a problem with it? It has not been
We'll
a
see.
problem yet. Sorry?
I said, we'll see.
Yes, there could be a problem. See, the underlying long-term strength of a currency, especially fiat currency, depends on the military and economic power of a country. And with the relative redistribution of power across the world, especially in countries where there has been accumulation of US dollars, if there is a readjustment, then what happens is the US, that will create, that may create some uncertainty with respect to the sustainability of the same levels of the US dollar. Now, that is not going to happen anytime soon, right? It's probably 100 years from now, 50 years from now. But still, if you were investing instead of Chicago, you were investing in, let's say, Indonesia, for example, the rupiah, right? Indian rupee is rupee, right? They're the same currency. Rupiah and rupee are the same words. The currency of Dubai until 1970 was the Indian rupee. These are like historical economic trade networks that existed in place, all the way up to the Gulf and all the way to Southeast Asia. So if your expectation is that the rupiah is going to devalue, or how do you assess whether the rupiah is going to devalue? You've got to look at the whole spectrum of what is going to sustain the inherent strength, what are the trade deficits, what are the trade imbalances, what is the polity, how sustainable is the polity, if there is a problem, is there enough resources, foreign exchange reserves, other kinds of assets that the country has. Or there could be strategic depreciation, devaluation of the currency. Indonesia can say, we are becoming less competitive, everybody is depreciating around us, we too want to depreciate. That never works in the long run, because then you have a set of competitive devaluations across the world, which always leads to not just problems, but leads to war. So anyway, but you cannot guarantee what you can't control, and you should not. Unashamedly you say, no, what we can guarantee. And leave it up to the investor, whether you want to make your product so attractive. Then maybe they decide to invest in you, even though they expect the depreciation of the dollar, because they want the security of being in a US dollar denominated asset. That's another way to do it. But don't put yourself in the position where you are guaranteeing something which you cannot deliver. That's the bottom line. And here you have a way of looking at how to, the potential impact, and then you can do some scenario analysis around this. Okay? Now we go to question 3. We are still on question 3? Yeah, almost done. So evaluate the benchmark assumptions Zasky made. Would you have made different assumptions? What do you think is the fair market price of financial commons? Explain why your answer does or does not differ from 10,400. So now I don't want to get into all this. You know how to do this, right? This part you know. It was the logic of the model that was more important. So it's a 3-year holding period. So what would be your concerns with respect to wildcat? Let's go into that. Obviously, is a 3-year holding period reasonable? What happens if the market does not improve and investors have to hold the property largely longer than 3 years, which is inevitably always the case, if you especially in a fund structure. What else is happening with fund structures? When you set up a fund, right, we all studied the fund structure. Everybody is blindly going into private equity. But things are not static all the time. You have to be even more critical than that. Is private equity the right vehicle to invest? We touched upon this when we were discussing Pro-Invest, right? Historically, investors like the Yale Endowment and the Harvard Endowment, they made a killing by investing in private funds. They had large sections of assets invested in stocks and bonds, and they took some international exposure, but they also went into hedge funds and private equity funds, and also real estate funds, and venture capital. And real estate and private equity outperformed most of their other investments. But venture capital outperformed by a substantial amount everything else. For 20 years, 77% annual return from a venture capital allocation of your fund is a tremendous amount of gain. That's how Yale is where it is and NYU is where it is. NYU's endowment made an investment in fixed income securities. Did not want to take the exposure of equity. NYU has one of the, it's at the 27th from the top endowment amongst universities. Yale and Harvard is like to the top because they held to the premise that equities and taking on risk pays. So if you are investing in a private equity fund, whether first of all, whether it is the right vehicle, what does it mean, right vehicle? Does it have to be discretionary? Because it's a private vehicle, it is going to be illiquidity? Is the returns you expect compensating you for the illiquidity premium? How do you measure illiquidity premium? Well, you compare it. Well, everybody says private equity returns are very good. What one needs to do is go back and look at the equity returns, and relative to equity returns, what the private equity returns, the delta of the two should be telling you what the illiquidity risk is. Right? Will that illiquidity risk hold going forward? Investor doesn't care about the past, you're looking forward. Are the conditions in place that would allow you to sustain those illiquidity premium going forward? Many private equity funds will go out to raise money. Now, institutional investors are asking, tell us what the difference is between the public market returns and your private market returns. Are we being even compensated for this? So the nature has changed. Maybe 7-8 years is not the right vehicle. If you're forming a fund, 8 years, why are you getting yourself into trouble? Should you not have a fund structure which is 15 years long? Your investment strategy should dictate the life of your fund, and that doesn't have to be 7-8 years with 1-2 year extension options. If you're doing a private equity fund for an urban refill project, infill projects, you need a longer life to sustain yourself. Right? And is the liquidity premium for a 15-year investment going to be adequate to compensate you? Or you're better off just investing in public markets. Right? if you are going to a foreign country with a relatively volatile currency, should you just take a US model for a 7-8 year fund and go to that country? Maybe there is a different model. Maybe there is a model which is fundamentally different, or some kind of a mix of a different model. Should you mix your capital from United States with a domestic capital in place? Domestic, not private capital, a whole bunch of shenanigans happening. India, you go form a fund, they will sell you a Taj Mahal on your face and you will buy it, pay some money back. That's how people work. What do? Have you ever bought a Taj Mahal? Real Taj Mahal I'm talking about, right? They will come and they'll sell you, you get the title to this Taj Mahal. And poor you, my son is in Australia. I have to teach him, what is called knowledge, gyan. Gyan is the Hindi Sanskrit word. Don't go if somebody asks you to go somewhere with him. He's 20 years old. Okay? Because if you're an American kid, go somewhere, chances are you are in the radar of people, the local people somewhere. They will eat you alive. So you have to be street smart. Make sure you don't end up buying something which, certainly not the Taj Mahal. So in order for your capital to work in a third country, how should it work? Should it be mixed with it? Maybe you have a mix of domestic public market equity combined with private capital from the United States to construct something which is completely new, but more appropriate to your situation. Don't commit to some things which you cannot deliver. So it is a complicated world out there. Your genius lies in being able to find the focus, defining your investment strategy, working on your investment strategy for periods, long periods of time, being absolutely sure, going out and meeting people who will critique, challenge your ideas. Find your best professors, put them on your board. But they will have to agree to it because they also, their whole reputation is on the line. And then craft a product with a mix of capital that is the most suitable for it. And at the end of the day, everything is uncertain. There will always be uncertainty. All you can do is do your best. You can change the various terms of the structure. The genius lies in understanding the connection between the financial implications and the legal document, what it says. People ignore the legal document because they say, my lawyer takes care of it. I understand this. I've told my lawyer to put this in the legal document. They have done it. You have to go line by line, sit down with your lawyer, even if it costs you more. If they bring in 3 lawyers, ask the two to leave, just keep the main guy, right? Because they're not running the meter. And be ruthless about it. Same with accounting firms. You ask 2 people to come for a meeting, they'll send you 15 people. And by the way, they'll be billing you all the 15 people. So you just say, guys, leave. Please go. I just want to deal with this person. That's it. So ensure that what you want is accurately being reflected in the legal language. And you have to find a level of trust with your lawyer. A smart lawyer is a good friend, but there are very few good friends amongst lawyers. Nobody is involved. So, if you don't understand anything, sentence by sentence, ask them to explain what is mean. Explain numbers, and take $100 numbers. Explain piece by piece what it means. It will all become clear to you. There is no rocket science in this. It's just that people, we don't do due diligence enough. We just leave it to somebody's expertise, especially when some third party says they are an expert, so you assume they are an expert. You have to be your own friend. You have to have your own expertise. Very soon you will be in a position, you understand the financial analysis, you understand the legal lingo, you understand the intersection, and then you will start looking at the potential scenarios where things could go wrong, and piece by piece you fill that plug. And from that bigger plug you are hedging your downside. The key, as I have always said, is protecting your downside. Upside will, the more randomness, upside will good for you. All right, so this is our story for today. We did not take more than what? Finished in time, reasonable. Hopefully this was useful. You will find the real use of this when you build the model. Otherwise, the use will be only partial. Okay, there's small intellectual stories. Otherwise, you have to build a model. So next class, we're discussing Bussy Place, BUSSE, Bussy Place, on Thursday. And next Sunday, I have to decide what I'm going to do. My brother is in town, and Sunday afternoon I have to give an exam in this building. So I'm just trying to see what works best. I'll try to be here in the morning, but I'll tell you on Thursday. I'll send out an email. And finally, we don't have to worry about it. Is 20th? No, it's not the 20th. 20th of 21st is a Thursday. 21st November is a Thursday.
Yes.
I'm not going to be here. I'm going to be traveling, so that day there will be no class on 21st of November. But we have done enough classes, so I'm not shortchanging you in any way. And we'll do more classes. I'll try to keep the Sunday, next Sunday also.